Good afternoon, and I think we welcome you here in this session. As I was already introduced, I'll probably not spend more time introducing myself, but let me just give you a few words about what I do at the World Bank and what our team does. I work with the World Bank Finance and Private Sector Department for the Africa region. We cover the 48, 49 countries in Africa, extending support for creating the enabling environment that the private sector needs to mushroom and grow. In that context, it's important to make sure that finance flows from financial institutions to serve the needs of businesses. I'm here today with two distinguished panelists, which are representing very well-established development finance institutions, and we will be tapping into their brain and knowledge about what are the experiences in improving access to finance to private sector in Africa and elsewhere. Particularly, I would like to focus on small and medium enterprises on one side, and on the other side, you have access to finance for infrastructure development, which is critical. You will be hearing from Maktar Diop later today on what the World Bank does in this area. So I'm not going to preempt him. I will let him tell you exactly what we're doing. And I would like here to give the opportunity to our panelists to tell us a little bit more about what has been their respective experiences in promoting access to finance. So let me introduce them. I have on my right, Diana Noble, I got it right? Chief Executive of CDC, and she will explain to you what CDC means. It's a well-established institution which has gone over years through several transformations and has been very active in different overseas markets, including in Africa. On my left is Chel Roland. Is it right?
That's okay.
Good. He's Managing Director for Nord Fund. And Nord Fund is also very active in Africa, particularly Southern and Eastern Africa. And both do cover SMEs as well as infrastructure finance and do extend equity. Doesn't work? Is it okay? Both extend equity support, debt support, and many other financial products to private sectors initiatives. So we have more or less 4 to 5 minutes for us to entertain around this topic. And I would like them to give you a sense of what they do in this area and also to share with you the lessons they have learned over years of practice on the ground, and more importantly, how the development finance institution can get together and eventually work a little bit together in addressing the problem that we face in our countries. I will just give you one example and I will stop there. We just got a request from the finance minister for Nigeria. And Nigeria is one of the largest countries in Africa and largest market in Africa. And what we know in Nigeria as elsewhere is that finance doesn't necessarily reach the private sector and the small and medium enterprises in the private sector, which are really critical for government to respond to the job challenge that they do face. Question that she's raising is how we can catalyze that process, because we have seen that commercial banks are not responding to it, and that this is not necessarily a bad thing because banks are risk adverse, and this is normal. And she's clearly looking into solution, how to put in place a new development finance institution that can be commercially and financially sustainable over years and help bridge the market gap in terms of extending long-term finance to SMEs, for example. The same reasoning can apply to infrastructure finance. We know the infrastructure backlog that is holding Africa development back and its competitiveness. If this infrastructure was to be put in place, it's pretty sure that many companies, including yours represented in this room, will be rushing to Africa to invest more. So we're facing a broad agenda, but I would like them to tell you their experiences along these two lines. What are they doing respectively? What are the lessons they have learned in what they're doing? And how can that community of professionals can work much better and more effectively together? So I will probably open and give the floor to Diane so that she can probably share with you her experience and her view. Diane, over to you.
Thank you very much, Paul, for that kind introduction. So I'll do a quick introduction to CDC and what our priorities are, and also talk a little bit about our view on partnerships. I think the other questions you asked in terms of lessons learnt and coordination, perhaps we can leave to the following conversation so that I don't go on too long. So CDC, we say we're the oldest development finance institution, started in 1948. Our mission today is to support the growth of businesses, particularly for the creation of jobs across Africa and South Asia, to make a lasting difference to people's lives in some of the world's poorest places. And that's a mission that inspires us. We provide capital in all forms, very flexibly to the situation. We're actually able to take majority stakes or minority stakes. We can follow, we're increasingly leading transactions as well. We can provide capital directly or indirectly through funds. CDC has a well-established tradition for supporting private equity funds across Africa. Africa is very important to us. It's one of our only 2 regions. We invest everywhere in Africa, but we do have a preference for trying to push to some of the harder places, and we can talk a little bit more about that. In terms of our priorities are really set by the impact that we want to achieve. And our impact, we spent quite a lot of time, we did a strategic review last year, thinking about what was the impact that we wanted, and we really came down to 2 things. 1, the creation of jobs, and 2, trying to create jobs in places, particularly where the private sector is weak and jobs are really needed, so harder places. So now to direct capital and maximize the impact of the resources that we've got, we assess every investment that we make or every commitment that we make to a new fund across 2 dimensions. 1, how job creating is the sector that this opportunity is in, and we engage some academics and economists and consultants to give us a view on what should be our priority sectors. And then secondly, how hard is the geography? And the 2 axes kind of intersect, so that as capital goes to very hard places, we get pretty sector agnostic on the basis that any capital into really hard countries is developmental. But as capital flows to easier places, we become pretty sector picky. And that's led us to sector priorities, which are infrastructure, financial institutions, agribusiness, which takes CDC back quite a bit to its history and heritage, manufacturing, construction, health and education. The main priorities for us. Let me talk a little bit about partnerships, because they're so important to us. When you're trying to do hard things in hard places, and you have a team of, well, we're now up to nearly 100 people, but we're almost exclusively in London, achieving the impact that you want from one location a long way away means you need to work with other people, of course. And we are ambitious about the impact that we want to achieve. So it's slightly different in our different business lines. In equity, we believe in Africa there aren't actually enough businesses, that the economic base just isn't strong enough. And one of the things we really want to do is do business creation. But the way that we feel is best to do that is through joint ventures with proven international operators who are ambitious themselves, and then we can do it in partnership with them. In the very hardest locations, and we do have an aspiration and a strategy specifically targeted at the very hardest locations, like, for example, North Nigeria or South Sudan, we have a locally adaptive strategy to try and seed and grow new businesses. And again, we couldn't possibly do this by ourselves, and we look for local or international corporates to work with to do that. In debt, there's a huge collaboration with other DFIs and we work mostly behind the IFC and DFIs like DEG and FMO. This is a business that's very well established by them. We are very happy to work behind them. And then funds, which is a core part of what we do. Inherently, that's a partnership model, of course, because we are providing capital to trusted partners to execute strategies that we believe in, where we feel we're very aligned over the long term with them. So I'll stop at that point, and then we can move on to...
just before I hand it over to Chel, I just want to, if you can elaborate a little bit further. I think the issue that I see on the ground, when you look at Africa Prospect, you have a lot of young people with a lot of bright ideas, but we always say access to finance, meaning access to credit, whereas what really is the problem is access to equity. To which extent are you touching to that specific aspect of your agenda so that we really can have impact on the job?
No, of course. We actually consider ourselves more to be an equity house than a debt house. And those are the skills that we put in place, whether it's, again, backing funds who are providing equity on our behalf or providing equity directly. My guess is that, over time, and this is all work in progress, we'll be probably 60-70% equity and 30-40% debt.
Okay, excellent. Chel, over to you.
Thank you so much. Before sort of give you a short rundown on Nordfund, let me only mention to you that both CDC and Nordfund is a part of EDFI, the Association of European Development Finance Institutions. We are 15 altogether. And in terms of portfolio and annual investment, I mean, if you look at the EDFI family, I mean, we're similar in size to IFC. So it's fairly significant in total. I think where we differ from IFC is that we do, on average, smaller deals, smaller investments. We are more SME oriented, and also the 15 EDFIs. To me, the beauty about the EDFIs is that we're so diverse. We're different in size. We're different in sort of instruments that we play. We're different in terms of geography where the footprints are. So in a way, I mean, in many of the poorer parts of the world, in particular sub-Saharan Africa, we are the substitute for lacking local capital markets. We come there with different skill sets and with different priorities. We sometimes compete. We sometimes work together, and that to me is really the beauty. In terms of Nordfund, I mean, how do we come into to this picture? We are one of the younger EDFIs, set up in 97, basically looking at CDC at that point in time as the big brother or sister. I'm not sure the sex of it. And the mandate that we were given is basically to create profitable businesses and thereby jobs and tax revenues for governments. Profitable businesses with local or international partners, operated on with sort of decent standards in terms of ESG, and gradually over time, hopefully take it to the IFC standards, which is basically what we're opting for. But we're willing to invest with partners and in existing businesses, which are far from perfect. But we need to agree on how to take it forward. Nordfund, in the present strategy, we are basically an equity investor. 80% of what we do is equity. The reason is that nothing is more lacking in this market than equity investors, in particular equity investors willing to invest in an early phase or do greenfields. So we have a target of doing 20% of what we do as greenfields, and being willing to take on board more risk than many private investors to do so. In terms of sectors, we basically do renewable energy, largely hydropower. We just a couple of weeks back closed a wind farm in Kenya and a waste treatment plant where the methane is going to be used for electricity in South Africa. We joined into the big solar plants, and 2 big solar plants in the feed-in scheme in South Africa. last year, fairly huge investment. So renewable energy is important. Then we do financial institutions, which is basically banks and microfinance, largely banks. And if there is a sort of commonality in terms of the banks that we work with, it's banks willing to work with SMEs, moving down the scale in terms of the size of loans and or lending to unbanked parts of the population. We also earlier this year closed a deal. For the first time, we were able to convince a few Norwegian investors, a couple of big financial investors and private investment house, to join us setting up an investment company that we will manage to do banks in Africa. We convinced people that banks in Africa is financially an attractive place to be if you can build a portfolio and take that forward. So we will significantly scale up what we do in the banking sector over the next few years. Thirdly, we do agri-related business, but also pragmatically other, both a bit of manufacturing and some tourism, but largely agribusiness, only in Africa. And why do we do banks and renewable energy and agri? Well, because we're convinced that if we, in one of these sectors, if we're able to develop or grow a well-operated business, that is development. We don't need to justify that particular investment. A well-operated bank in Africa is fantastic. A kilowatt hour is what they need.
Yeah.
So, or helping them develop the agri potential, which is huge and obviously needs to be part of the growth process in all of these, or most of these countries. Then, that really explains our mandate, our developmental, how we deliver on the developmental dimensions. So that's the short story. In terms of investment sort of thesis, we, due to the fact that we largely do equity and most of that, or more and more of the equity is direct investments, we believe that we need to be close to the investees. We don't believe in fly-in, fly-out investment. Doing this kind of investment, you need to be there, you need to work with the investees, you need to understand the partners, you need to understand the country and the culture. So for that reason, we, on one hand, we are geographically at the present concentrated in Eastern and Southern Africa. We don't do West Africa. There's nothing wrong with West Africa, but the size of Northern doesn't allow us to go beyond. We basically, at the present, the value of the portfolio is 3 billion US. We may take on board West Africa later, but for now, Eastern and Southern Africa. We have local offices in Nairobi, in Joburg, and in Maputo. And let me also mention that we don't do expats. We believe, even though there's a lot of challenges in hiring locally and all the different cultures and religions and, colors or whatever we have in the organization, we believe that building a local presence with people with a long history and network in the region, that pays off over time.
Okay.
So that's sort of the short version of what we're doing to illustrate how we sort of pushing the borders. Diana mentioned South Sudan. We're also involved in South Sudan. We actually believe that we'll be able to build a hydropower plant in South Sudan, which is really outside, any sort of normal commercial sort of logic. So the way we do that is to find ways to blend grants from the Norwegian government and ownership participation by the South Sudan government, and a lot of time and resources from our side, I must say. Okay. But it proves, at least it proves to our stakeholders that we're willing to take it one step beyond what the private sector would be. Similar, I mean, 2 weeks back, we closed the first deal in Myanmar, a microfinance investment in Myanmar. Again, we've been working on it for 3 years. We spent enormous amount of time and resources to get it through the bureaucracy and decision-making machinery in Myanmar. And Myanmar not being Africa, but let me say Myanmar is probably the most challenging place in our present portfolio. I mean, no place is, you don't have the infrastructure in terms of regulations and laws, and you don't have a concept in the heads of people. So, but it proves again to our stakeholders that we're trying to do and push the border and do what the DFI is supposed to do.
Okay, excellent. Let me just ask you one question. I think one thing that I noticed is that you really put the emphasis on the concept of being very close to your deal side, the deal generation side. I just wanted you to elaborate a little bit further in terms of what are the binding constraints that you see from your DFI initiative that are coming from the policy end, which, if addressed, could ease your work.
I'm not sure.
When you do a project in Myanmar, you have some constraints which are policy related.
Yeah.
Okay. Some of these policy constraints are holding you back from expanding your exposure or from slowing the process in your decision making.
Sure, but that's, I mean, we are an investor. We don't do institutional capacity building. We don't work with the governments. I mean, the aid industry is full of those actors. We only try to do it on the ground.
But
so
what government could do to ease your work as an investor? Because when you go to a country, I mean, some of the procedures that government may have in place are probably also holding you back.
Absolutely. But what I'm saying, I mean, the way we understand our mandate and our role is to act as an investor. I mean, and in this regard, we would move more or less like any private investor. Okay. We accept the terms and conditions decided by the government. Okay. Sometimes, I mean, in this case, it's been quite cumbersome, but there's nothing we can do about it. We try, of course, I mean, in this particular case, I've had to do a small microfinance investment. I've had meeting with the president, the central bank governor, the minister of finance, the minister of planning, the minister of the president's office, and they all so much supported it. Yeah. However, in the end, we were not able to get the approval in the central bank, so we had to do it without an approval.
Okay. Good. You want to react to that?
No, I think Charles is absolutely right. I think we have to work within the constraints we have. I mean, it's such a big question. Every single sector, every single country is different and has different constraints, and we have to sort of navigate our way around and try and choose where it is possible to do things and also where it's possible to accept the risk that we're taking. The key thing is to understand the risk that you're taking and make the decision accordingly. You know, as an organisation, we don't try and change policies, but we will. We have DFID alongside us, who that's much more their role to do that kind of capacity building.
Okay, of course. I mean, the question comes from the fact that when you ask investors, most of the time they will tell you if government were to do this and this more faster or more effectively, we would be able to probably also mobilize ourselves a little bit more effectively. But that's being said, I think one thing that you may want to add to both of your presentation is really, I mean, an illustration of what you currently do in Africa in terms of exposure, in terms of maybe key highlights, investment you have done there. So
CDC today, if you look at our portfolio, about just less than 50% of it is in Africa. So that's about $1.7 billion. And that's all invested through funds at the moment. We made a big strategic decision 18 months ago to expand the way that we provide capital to our markets. So in 5 years' time, we would expect funds to be probably more like 50%. That's not actually, that doesn't mean though that we're reducing our commitment to the African private equity market. For those GPs in the audience who might be feeling nervous at this point. At the same time, we stopped investing in China and stopped investing in Southeast Asia and Latin America. And basically the cash flow from those legacy businesses and those legacy portfolios will fund our new business lines. We expect our commitment to the private equity industry to remain as strong in Africa as it has done over the last 10 years.
Great. Want to?
Yeah, if I may pick up on that, I mean, we also do PE funds, SME PE funds, but less so than in the past, partly because we have a good pipeline of direct investments, but also for the reason that in most part of Africa, you see a number of private equity funds on the ground, so they're actually there, and they're more and more able to attract also private capital. So when we do PE funds today, it will be in funds that sort of fill gaps in the market where they're really needed. But also, I would going back to some one thing mentioned earlier, sort of the flex that we as a DFIs we're more flexible than a fund in terms of we doing equity. I mean, in terms of how long we'll stay in there, there will always be an exit logic to what we do. But we could stay in for 5 or 10 years or beyond. And I think what you see in some of these markets in Africa, you see one PE fund selling their stake to another one, to a third one, and that to me doesn't make much sense. An extremely expensive way to provide equity to small and medium-sized enterprises, making them too short-sighted, too financially oriented. So and then sort of the capital that DFI, it's not that PE funds are not needed; they're definitely needed. But also you also see a need for equity with a longer time horizon and able to follow the growth pattern of a particular investee through whatever cycle they need. Okay. So we will be much more sort of flexible in terms of how long to hold on to an investment.
Yes, as an example of that, Shell's organization invested in a Ugandan bank alongside us, DFCU, earlier this year. We sold some of our stake to them. That was an investment CDC first made in 1964. Now, I wouldn't say that's a typical tenure for us. It's kind of unusual. But it does demonstrate the point we can be really, really patient if we want to be.
And it's been a good investment for you, and it's an excellent bank, and it probably wouldn't be there if CDC was not there in the first place and willing to hold on over an extended period of time.
So in 50 years' time, Shell will still be there.
Well, I mean, perhaps not be the model, but I think, I mean, the advantage of us, or the DFIs, being more flexible in terms of the period to hold on to, I think is one of the advantages that we have.
Excellent. Now, you have heard the introduction from the panelists, and I think you may have some good questions to challenge them or to push them for clarification. Maybe there's a mic, and just introduce yourself and ask your question, please.
Cherry from Bisclean. Now, I'm a little bit, I would like your opinion on the size of the portfolio. You made a comparison, and I think this morning we also heard that the portfolio of all European DFIs is about 27 billion. That's about 3 times the portfolio of one company that I know. I will not cite it, but just one. So the question is, are the constraints really on your side or on the demand side? Is it because the business model is not right, or the business models that are used are not right, or really because there are no bankable projects, etc., and that in fact you cannot increase? Or is it simply comfortable to stay at that level because there is no need to increase? I'm just raising the issue because any level we can discuss whether it's too much or too low, but it seems to me rather on the low side.
Okay. Excellent question. I think we can take that one, unless...
Sure.
Maybe there's a second one, and then we take the two. Yes, go ahead. Yes.
My name is Tembi, and I'm with Agora Partnerships. They facilitate impact investments for Latin American countries, but I'm originally from Malawi. That's why I'm here. I think throughout the panel, I was just thinking to myself that finding the right companies to invest in seems to be like a theme, or at least that has come up in a lot of the conversations that have been going on today. And for example, in Latin America, accelerator programs that actually go out there, find like the best entrepreneurs or companies, and then provide them with like training and mentorship have been a very big key factor to providing investments to companies in Latin America, and haven't seen a similar trend in Africa per se. So I want to get your thoughts on, do you think there would be a change if we had more accelerator programs in Africa, and would you partner with them? Do you think that would be like a good solution to kind of dealing with the pipeline problem that's faced throughout the continent? Thanks.
Excellent. The third one, yeah, gentlemen. And then we take the three.
Good evening. My name is Jacob Maga from Pan-African Exchange. We are an operator of derivatives market and equities markets, just startups. My question is, will you be looking for exits mainly to list in some of the companies that you have in your portfolio? And at what growth level will you be looking to exit?
Okay, good set of questions. Let's take the three.
Okay.
Who would like to go first?
Shall I have a shot on supply and demand? I'm going to talk about it in a personal way rather than in a total market way, because each institution will deal with this question differently. But actually, this is very top of mind for me at the moment, partly because when I took the role at CDC back in 2011, as I said, we just shrunk our geographies, so no more China, no more Latin America. And we have a $4 billion portfolio. And to be honest with you, I looked at the $4 billion and I looked at the markets that we were investing in, and I thought, we might have too much capital here. And might be difficult to find enough investable opportunities. And no one in an investment institution wants to be sitting around the investment committee table thinking, I have to say yes, okay, to everything. I sit here today, nearly 2 years later, feeling completely the reverse. It's fascinating, actually, how much demand we've seen out there, and we've barely tried. Okay. We, as I say, we're now 100 people. We've grown our teams very quickly over the last year. Now, it may well be because because opposed to the financial crisis, but Basel III, commercial banks pulling in their horns, end of quantitative easing, less capital in the markets, and therefore the role of DFIs is so much bigger at the moment, and probably bigger than it's been. Charles will have a much better perspective on where we are in the cycle, but it seems to me that the demand is huge. And so we actually do have a choice as an institution as to whether we want to get bigger or not. Now, that's not going to be my choice, it's going to be my shareholders' choice, but we will be going to them and saying, this is what we can achieve with our current capital, which is constrained, we think, compared to the markets. And in a way, that's quite good, because that forces us to be very strategic and very impactful with what we've got. Or you could have a bigger balance sheet and we could do much more. So that's just how we feel about the market situation.
I think this is very much in parallel to where we are. I mean, first of all, let me back to the 27 billion of fund under management in ADFI. It's been growing. I mean, the ADFI family has been growing. Between 10 and 20% a year over the last number of years. We have been growing by 20% for the last 10 years. And no problem going on doing so also in the future. So that said, I mean, it's definitely, there are investment opportunities out there. On the other hand, in terms of greenfields, in terms of starting up new businesses in the early phase, there's definitely a lack. I mean, there's a lack of pipeline. It's difficult to find the right partners, the good project. So that's why we have decided to, like in renewable energy, to set up a product development facility. So when promoters come to us and say we have a good hydro project or a wind project, whatever in Africa. We will do a sort of first assessment. If we believe they're basically capable to do it, we often join in and say we'll pick up 50% of the development cost until closing. Because that's where capital is really scarce. And it's been quite successful for us in growing that part of pipeline. If the project doesn't close, well, we have to write off the time and resources invested, like the promoter. If it closes, it's converted to equity or loan. That said, I think this is where there is an important sort of division of labor, perhaps you should say, to traditional grant aid. Africa is full of feasibility study in the energy sector. There is not an energy department where the closets are not full with expensively aid-funded feasibility studies. So far, in my time in Northern, I've not seen one of them being picked up by an investor and actually being implemented. And the reason being that the aid, the grants are given to the government, and they hire consultants, and they produce reports and put them on a file. There are no connection to the investor. So that's why we've said to the Norwegian government, but also in places like this, stop doing these feasibility studies. Unless you're able to find a way, or much better give it to private investors who are actually willing to take it forward. Or like what I said, what we do in a project development facility. Why don't use the grant money and go to and allow private investors to come and ask you to fund 50% grants and take it forward and stop producing all these documents for the pipe. So building pipeline and greenfield is important, and in particular in agriculture, in renewable energy. Greenfields are definitely needed. What Africa needs is all the unborn businesses, and helping that, more of that happen, then you need instruments that allow for more of that to happen.
There was another question on exit, because you said you
on exit and
long-term investors.
Long-term investors, so there will always be a well-defined exit strategy. That could be a listing. If we believe it's a company that are ready for the market, so there could be an agreement to list it in a number of years, providing so and so and so on, or a trade sale or what have you. There are different ways of doing it, but definitely listing is one option that we use to a certain extent, even though it's difficult. You don't find that many investments in Africa unless you're up in a mid-cap that are really ready for listing.
So at the end of the day, we all in DFIs have a renewable balance sheet, and exits allow you to do more in future. So they're your lifeblood, and when things get to a certain stage where you've achieved most of your objectives, it's time to pass it on to someone else.
Okay, good. Where's the mic? I think we have time for a second round of questions.
Brad Gibbs from Mara. Actually, I can help address the question on incubation, if that's helpful.
Okay.
I've been actually quite heartened by the level of incubation and angel networks that are extending across the African continent. Accra, Lagos, Johannesburg have very active angel communities. And then importantly, particularly in areas like East Africa, such as Nairobi, you do have developing kind of technology-based corridors where you have the full life cycle or ecosystem of helping train entrepreneurs, everything from, to your point, mentorship, subsidized office space, and then ultimately you're going to see an emerging micro venture capital community. So a lot of activity, but also I think there is a need for a lot of cross-border learnings, and I think that the U.S. venture capital community could certainly be very, very helpful in terms of partnerships with these emerging incubation and acceleration groups to help them ascend the learning curve. So happy to chat more about that. We at Mara run incubators in Dar es Salaam and Kampala, so I have some first-hand experience.
Okay, thank you for the contribution. Yes.
Not francophone. Did you say francophone?
Yeah, go ahead, please.
Just a quick question to Norfund about, you said you do SMEs, you focus on SMEs. What's the minimum you would invest? How low dollar value? Because when you talked about the examples, you talked about hydro and I think it was banks. So does it mean they're not really SMEs, or SMEs that feed into those sectors, or do you do standalone SMEs that are smaller than banks?
Okay, go ahead. Just respond. I think we're getting close to it.
Answer is fairly simple. Norfund wouldn't directly, we'd be very reluctant to go below 5 or at least 3 million US, but 5 I would say, and would rather do 10 and 15 directly from Norfund. However, that's why we use PE funds. Then we're looking for GPs willing to go down to the lower end or to the S of the SME. Because they're local, you can't. The transaction cost for us of doing smaller investments, even though we have local offices and most of it is done, it's going through the whole the investment decision-making processes and back to Oslo. So for that reason, not below 5 million, but as funds, if they're willing to, basically looking for funds willing to go down to 500,000 or a million or two. Because those actors are lacking out there in the market.
Any more questions? I think there's one point that was raised, which I think resonated a lot with me, which is the issue that you raised on the feasibility studies. And we are in this room and we're trying to solve this problem for the past many years. And we're still bumping on a big stumbling blocks, which is clearly somebody raised it. We don't know whether or not it's a chicken and egg problem that we're dealing with. On one side, we have a lot of money likely to flow to support some of these projects. On the other side, we don't see a lot of movement on the project side, because when you refer to greenfield operation, you also stress the fact that you don't see a lot of good projects or good sponsors. It means clearly that we need to figure out a solution on how to get studies done according to what is required for investment. What we're doing now in terms of studies, more or less, probably to inform decision-making process on the policy side, on the government side, which is probably different from what an investor would need. And I feel that's what we need to change in terms of probably organizing a two-track. And I would like you to discuss a little bit this, because as DFI, you know what you're receiving in terms of project from sponsors, and you're not very happy with what you're receiving. What can we do upstream to make sure that at least you get requests which are well prepared? Why don't you? I don't know, maybe CDC doesn't face the same problem.
No, we're really interested in trying to solve the early stage development of power projects issue in Africa now. It's great to see that Norfund has focuses on development of renewables, but there's a bigger market beyond that as well. And what we've seen is there has to be a big role for DFIs in this, because this is a non-economic activity. Commercial players have tried again and again and have got some things done and then had to exit because their shareholders, wherever they are, say that's not economic. And therefore, there needs to be commitment, I think, from the DFIs over a long time, and this is patient stuff and high-risk stuff as well, to provide the right kind of capital, the right kind of expertise, the right kind of relationships with governments to try and get these projects moving. Now, capital isn't the only part of the equation, of course, and I'm sure you're better qualified than me to talk about the relationship between all the parties, because clearly this is a jigsaw that has to be put together, that takes many years at the moment. And I think if you look at ways things get done in this world. Development of power projects must be at the most inefficient end of almost anything that exists, right? So there has to be a better way.
Thank you. You want to react on that? You raised the problem to begin with.
Yeah, I think incubators make sense. Different ways to support private sector development projects make sense. Asking government to develop products doesn't make sense. That's what I'm saying. And too much of the grant-based aid work with governments and ask government to pretend being actors in the market. And this is, I mean, particularly I've seen it, as I said, in the renewable energy, in hydropower. I mean, there are hundreds of millions of US dollars in feasibility studies all over sub-Saharan Africa, and it's all waste. And I think historically it starts out from the fact that the traditional aid has been sort of very reluctant to work with private sector, being afraid to subsidize somebody that somebody could benefit from it, and I think that I mean the blending discussion is a good one, and it's difficult, and it's important not to and it's important how you do it, but you have to find better ways to work with private sector and blend the grant-based resources with private sector, and it's better that it doesn't fit 100% every time, but it actually creates something on the ground than just ending up on a file.
Yeah, I fully agree with you on that one. What I would like us to also help frame is how we can address the issue. I mean, one thought we have floated around was to make most of these project preparation facilities. I mean, you guys have funded some. World Bank is funding many in many countries. For the time being, these project preparation facilities are only accessible to government entities. And we're thinking about making them accessible to private sector. Question would be now how you organize that.
That's difficult. That's a tricky part of it.
Okay.
Yeah.
Okay, good. So, yes. And then we close. I think, yes.
Barbara Samuels, Global Clearinghouse for Development Finance. You position yourselves as investors. We talked about the difficulties of developing viable projects. How would you describe the issues that face you with regard to risk mitigation? Take, for example, energy. We know that a lot of the off-takers are not credit-worthy. So you have the issue, and maybe we should be specific. Right now there is a huge issue in Tanzania because TANESCO is having real payment issues. Meanwhile, you have a lot of off-grid projects, but there you have a different kind of risk in terms of the willingness and ability of the direct consumers and small businesses to pay. So given your framework, how do you deal with those kinds of issues? And earlier today, we talked about the need for DFIs to work together. So I'm curious if in some of these deals you look to the World Bank Group or ATI or others to help you with those kinds of issues. Thank you.
Quick answer, because we'll wrap up. Who would like to start?
Should I start? If I may, one step back in terms of the issue of subsidizing private sector. I think one of the beauty of the DFIs, at least the way it worked with us, is that it's so much less of a problem for us to ask the government to give us grants to take project forward. Because if the grants should in one case be a bit excessive, well, it ends up at a Northfront's book and not in just whatever private actor is involved. Okay. So that's where the DFI in itself is part of the answer, but only part of the answer. To your question, I mean, very often one of the biggest problem we have is really the counterpart risk and the PPA, the power purchase agreement. And there's been a bit of initiatives by MIGA and by African Trade Insurance and other similar institutions to move into that space. We believe that's extremely important. And again, that's where you could, you should use a bit of the grants that the governments are providing to make capital available to scale up that sort of risk mitigation.
Okay.
Because that will then you will see more of these projects moving forward.
Okay, good.
That's very
Can't
helpful.
improve on
We
that.
can close it. So eventually, let's give them a big round of applause and thank you all for your patience and for your participation. Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.